Good morning. My name is Matthew Brown. I am one of two co-chairs and founders of the National Energy Improvement Fund. But today I'm playing a role as kind of instructor and moderator, if you will, for the ACEEE Financing, Energy Efficiency Financing 101 2-hour program. Hopefully you are all in the right place and are excited to have a virtual energy efficiency financing 101 presentation. So before we get started, I just wanted to mention a couple of housekeeping things. First of all, just a thank you to ACEEE for putting this on. A specific thank you to Nick Henner and Kim Williams, who are on this call from ACEEE. Also a thank you to Jensen Handwerk, who is with NEIF. Both Nick and Jensen are going to be monitoring the chat function on this presentation or during this presentation for the full 2 hours. All of you are going to be muted. There were something close to 150 people who were registered here, so we decided that it would really be best to mute you all. And we will have speakers who will be speaking during this, during the presentation, who of course will not be muted. So, but just use the chat function to ask questions. Jensen and or Nick will be answering as best they can, or else we'll be saving questions for a discussion at the end. What we're going to do is I'm going to spend no more than 30 minutes giving kind of an energy efficiency financing 101, just to get us all on the same place for terminology. And then we are going to have a series of speakers, and those speakers are shown in the agenda, which I just put up. First of all, we have Peter Chrysa, who's my co-chair and founder of NEIF, but has a long history working with residential energy efficiency finance, going to speak. We have Charlie Lord with Renew Energy Partners, who is speaking about energy services agreements. We have Mike Doty from Greenworks Lending talking about commercial PACE. And we have Kim Stevenson from Inclusive Prosperity Capital talking about ways to bring finance and finance offerings to what I'll call generically kind of harder to serve communities. So all of these sessions, all of these speakers have been brought in as a result of a survey that we did, that ACEEE managed a couple of weeks ago. I appreciate many of you. We got something like half of the total attendees who were ended up putting in a topic that they were interested, but there were overwhelmingly there was a lot of interest in these different topics. So that's what we're going to do. I'm going to again speak for about 30 minutes, and the goal of my discussion is to really try to get us all on the same page with terminology, to give you an orientation to energy efficiency finance, to get you a good sense of what is what the terms are and what the basic considerations are, which will then be useful to you as you're hearing and talking or understanding what the other presentations are going to be about. So let's just dive in. First of all, what are we talking about? We're talking about finance. Easy word, right? What is finance, basically? Finance is a means to get money from a capital provider to a customer to support energy efficiency. Easy enough. That's the easy part. The hard part is really getting that money back over time, right? So unlike a rebate, unlike a grant, where a capital provider of some sort is essentially giving money away, it's a one-time transaction. Financing involves both sides of the transaction and getting money back over a long period of time, managing risks, managing compliance, managing yield, bringing in different types of capital and sources of capital. So there's a lot to it when we are talking about financing. And when we're talking about this kind of very simple transaction, give money, get money back, right? When we're talking about energy efficiency finance, we're talking about kind of a subset. And I've been doing this for a long time at this point. So I've kind of got a pretty good sense of what's working and then how the field has evolved over time. And I guess there are several areas that I really focus on as unique to energy efficiency finance. One is small dollar amounts. So typically, if you look across the hundreds and hundreds of thousands, perhaps millions of energy efficiency loans to residential customers over the last 20 years, there's an average size. It's a very, 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 very typical size of about $8,500. That's not a very large loan, right? The interesting thing is it's typically a larger loan size than most people are going to be able to put on a credit card. So it's a larger than a credit card, but it's also typically smaller than most people are going to put on in a home equity loan, right? So there's kind of a on the residential side, it's kind of the energy efficiency lending kind of fits in kind of a unique position. In the commercial side, we've been lending as NEIF for a number of years, just like in the residential side. We're seeing typically $30,000, $35,000 as a typical size. That again, on the commercial side, that's a small loan. That's not a very large loan. So secondly, energy efficiency finance is kind of a complex, interesting blend of finance, of regulation, of policy. I sometimes describe what I do as kind of sitting at that intersection of those three things: finance, regulation, and policy. But if you look at the number of players who are involved in energy efficiency finance, you've got public utilities commissions. Excuse me. I've done a lot of work over the years with the California Public Utilities Commission. You've got state agencies. New York State's Energy Research and Development Authority has been involved in finance over the years. You've got green banks, which are quasi-state entities or quasi-local entities, Michigan Saves being an example. You've got energy efficiency funds, which use ratepayer funding, which are overseen by state regulatory commissions, sometimes overseen by other types of public entities. So you have all of these different types of regulation, of policy, kind of governing what's happening with energy efficiency finance. So it's kind of unique in that way. Underwriting, specialized underwriting. Very often what you'll see is that underwriting isn't just looking at consumer credit or commercial credit. It's looking at energy savings. It's looking at utility bill payment history. It's looking at the particular equipment. Is it an AFUE 95 or better? Is it an AFUE 97? Is it a SEER 16 or better? So you've got specialized underwriting, specialized skills that are required there. You've got different types of risks. You've got political risks to the extent that you are engaging government money, which may or may not be available in the long term. You've got installer or contractor risks. Typically in energy efficiency finance, you are having a contractor install equipment, but what if that equipment is installed improperly? What if the consumer doesn't discover that, the borrower doesn't discover that until 6 months or a year into the project? At that point, the contractor's been paid, right? So there are risks that, because then that consumer says, gee, I'm not going to pay my financing charges because I'm annoyed with the way that the project was installed, right? So there are contractor risk, installer risks, some technology risks, although frankly, in most cases with energy efficiency technology is pretty well established. What's interesting also, I remember about 10 years ago, 12 years ago, when we were just kind of getting into this whole energy efficiency finance world, people would say, gee, wouldn't it be nice if there were a specific asset class that really defined energy efficiency finance? And at this point, what's interesting, I think, 10 or 12 years later, is that asset class exists. You can now go back and look at 15, 20 years of specific energy efficiency lending. And you can see the kinds of results, the high performance for energy efficiency lending. So there is an asset class, and there's a very good argument for using energy efficiency, its performance history, very, very nicely to establish that asset class. And finally, regulations, state and federal regulations. We're going to talk about that more. So when we're talking about when we're talking, I had about 6 slides that went ahead there. So when we're talking about energy efficiency finance, and we are talking about these various types of factors that make energy efficiency finance unique, we are first of all talking about capital providers, right? Who's providing the money? And I've kind of listed a set of different types of providers that are that fund energy efficiency. Private investors, so you can have investors they're not banks, they're not credit unions, they might be looking for higher returns, but they can be a significant investor in energy efficiency. Banks, credit unions, key thing is regulated financial institutions. Foundations who have a particular interest in serving low-income customers. Maybe they have an interest in environmental support. Utilities, in the case of investor-owned utilities with ratepayer funds or shareholder funds, different types of interests there. Insurance companies and pension funds, very low risk, but very long-term, very low cost of capital. And then a whole series of other funds that serve energy efficiency, greenhouse gas program fund, compliance payments, government funds, and so on. But when you're looking at all of this, you need to start to consider a set of questions when you're looking at different capital providers and understanding that different roles that different providers have. If there's maybe a general rule of thumb, it's that for the most part, the lower risk providers, in other words, the providers with the least risk tolerance, have the most money. So energy efficiency funding supported by an insurance company, which might have wonderful long-term capital available, is actually going to be least interested in taking a lot of risk, right? Banks, credit unions as regulated entities may be less interested in taking a lot of risk. There's a lot of money there, but there are also other types of funding, for instance, utility ratepayer funds that have been dedicated to energy efficiency, or grant funds, much smaller amounts of money, but willing to take the risks. So amount of funding that's available is an important consideration. Return that money requires. When you look at the various types of funding that are available, banks, for instance, credit unions, have money that's available at very, very low cost at the moment. Right, but their risk tolerance is going to be much lower, right? So that's that level of risk kind of discussion. Is there a public purpose to that money? So foundations often will provide some money to support energy efficiency. You're going to hear a little bit later from Kim Stevenson from Inclusive Prosperity Capital. IPC has received funding from the Kresge Foundation to support what they do, right? That is public purpose money provided by a foundation. But often you can see that multiple different sources of money can be actually combined, right? So in that case, you can end up with a combination of some type of what I call flexible capital, with senior, less risk tolerant capital. So the example might be a case of Michigan Saves. Michigan Saves has started out maybe a little bit more than 10 years ago with some state money provided ultimately from ratepayers in the state of Michigan that was able to serve as essentially a loss reserve or an insurance policy, which enabled capital providers in the form of credit unions to come in and provide a financing product that they would otherwise not have been willing to provide at a rate that they would not otherwise have been willing to provide it, right? So in this case, this is an example, Connecticut Green Bank. A lot of green banks that you hear about offer capital that can be structured into an overall capital structure to offer either a loss reserve or some type of subordinated lender or other equity investor. A subordinated lender, as opposed to a loss reserve, is somebody who is an entity that actually participates in the loan funding But in that participation, they may be willing to take greater risk than a senior lender, than a senior capital provider. So you could have a junior capital provider, a subordinated lender, taking what we call first loss position, demanding a higher return than a bank, but blended into that overall capital stack, allowing the customer ultimately to get a lower interest rate than would otherwise be available. So another structure that you'll see with different types of capital mixed in is that capital can be used at different stages of the financing. Some providers may be willing to provide capital for a shorter term, for a year, for a quarter, or for even 2 years, where there are other longer term capital providers who are willing to hold a portfolio for a much longer time. When you take all of this together, you have kind of different factors, who's doing who's providing the capital, what type of risk of loss are they willing to take, what type of origination and servicing services are being provided, you end up with what we call a rate build. A rate build will often consist of a cost of capital. We'll just choose 3% right now. You've got a risk of loss. Now that risk of loss is based on historical expectation of what loss is likely to be. I can tell you, given the long experience in residential energy efficiency finance, given the types of underwriting that's been in place for a number of years, that risk of loss is basically assumed to be 1% per year or less. So again, very much depending on the type of underwriting. You have origination and servicing. In other words, there are costs to origination and servicing. This number really varies. In fact, all of these numbers vary, but ultimately you end up with this rate build made up of these 3 different elements to come up with a rate to the consumer. You can play with these numbers and you could say, I'm going to allow my losses to increase and maybe from 1% to 4%, because I want to serve a class of customers that is riskier than the typical class of customers that's been served by a lot of energy efficiency finance historically. If you increase that 3% and you want by 3% and you want to therefore recover your capital through an interest rate, then your rate is going to increase by that 3%. So it's a fairly simple kind of formula, but just kind of keep that in mind when you're thinking about the cost of the interest rate that is provided to a customer. So that's the capital side. Let's focus for a minute on origination. So there's a phrase actually that my partner Peter will often quote his dad, who was in the energy or in the lending world for all of his career, and he used to say, "A loan well closed is a loan half collected." So what does that mean? That means if you originate well, then you are going to get your money back in the end plus your interest. You're going to control your risk, right? So what does the originator do? There's a function. They take in applications, right? They might, in the old days, these applications would have been down at the local bank, perhaps filled in via paper. You could have email applications. The trend more and more is to have online applications. I will note that in most cases, we would have a strong preference in looking at any program that there be an online application available. Paper, email can get lost. It's slow. Typically, if you refer back to the very small loan sizes, it's quite important that you have a very easy way for a customer to make an application and for a lender to be able to process that application. An originator underwrites an application. They're going to pull credit. There might be a pre-screen meaning pulling credit without, it's what we call a soft pull, not affecting the customer's credit score. This means that there's an interaction between that originator and, say, TransUnion or Dun & Bradstreet on the commercial side or CreditSafe on the commercial side. There might be a requirement for some type of proof of income for certain types of borrowers. Maybe borrowers who have a lower credit score might be asked to provide a proof of income. Borrowers who are self-employed might be asked to provide a proof of income. Ownership, title searches, and so on. actually fairly rare in the energy efficiency world, which is heavily based on equipment finance, not really looking for property information. And think about again, that small loan size, the need to have a very efficient process and a less expensive process. So you can't have a mortgage type of lending process that requires the fees and the time required for that. In some cases, an originator is looking at utility bill payment program or a utility bill payment history. So an originator is determining what we call pre-approval conditions. They're notifying the borrower, they're notifying the contractor that the contractor can proceed with the work. The originator is issuing the document package. Typically, again, or more and more, we're seeing this done online with e-signatures and such. They're collecting those documents. They're ultimately funding the contractor. Typically, what we're seeing is that it's the contractors who's ultimately funded, as opposed to the customer being funded themselves. So the next is what we call the eligibility considerations. So this is when in the underwriting side of things. So for instance, creditworthiness. On the commercial side, a typical small loan of $35,000 would look at a credit score and other publicly available information and provide a decision within a couple of hours. So we run a program with the Sustainable Energy Fund in Pennsylvania for a small business. And in that case, we have an automated interface with our credit bureau. We're able to get the credit result for that borrower within minutes. There's another program, and a residential program in Maine that we run called Efficiency Maine. Same kind of thing. We have an automated interface. We're able to just kind of in the kitchen, on that kitchen table kind of transaction, get that view and assessment of that potential borrower's credit rating immediately. Very important to be able to have that process be done as quickly as possible. Property and property improvement values. You're going to hear a little bit later from Mike Doty from Greenworks Lending, and you're going to hear about property improvement values. And in some cases, there are commercial PACE programs that require that the installed equipment and the cost of that installed equipment not exceed a certain level or a certain dollar amount as compared to the total value of the property. So sometimes that's another consideration. Income screening. So we're launching a program in California that is offering interest rates of 0% to customers of certain income levels. Project metrics. So are there project energy savings? Are there greenhouse gas emissions that are included? So you're going to hear a little bit from Charlie Lord from the Renew Energy Partners, who is going to talk to you about what they do with energy services agreements. One of the key missions of Renew Energy Partners is to reduce greenhouse gas emissions. That's one of the first things that they're always looking at. So they will be looking at that. You will find that commercial PACE programs often will require that there be, in some cases, a minimum energy savings level. So types of entities that originate are either, could be the banks, community development financial institutions, third-party entities as well. So now we move from the first kind of process of origination. Now we're going to talk about servicing. So when we talk about servicing, we're talking about the entity that is kind of doing the work to collect the money over, it could be a few months, it could be 20, 25 years. So it's a very important function. A servicer is going to be calculating payments due, adjusting those payments due. If there's a prepayment, workout refers to a customer who has had trouble in paying their loan. So that servicer is going to be working with those customers. They're going to be doing collections. So collections in the finance world refers to dealing with customers who have encountered problems in making their payments. So it's not just doesn't just refer to making repayments. When you talk about collections, it is doing what needs to be done to get an overdue or a past due loan paid. Servicers will report on delinquencies, address charge-offs, and so on. Often you will find that you've got different investors involved in a loan or in a particular set of loans. As I mentioned before, it's the servicer is collecting that money and then allocating that money to different types, to those different investors. Really important here, and especially in the consumer lending world, truth in lending, state licenses. Every state has a different type of lending regulation. So in some states, it's a very, I was going to use the word onerous. I think maybe it's the word a very thorough process. In other states, it's a very easy process. And it really just depends on the state. In some states, there is very little that's required beyond, so long as you don't offer a usurious interest rate. Maybe it's an interest rate above, say, 16%, very little requirement. In other states, to do any type of lending, there can be a very thorough process for getting that state license. The types of entities that service, again, the same kind of thing. You've got your regulated financial institutions, but more and more, and I guess I want to be kind of clear on this, what we see is that because of the small loan size, because of the complexity that I've been outlining, very often you'll see third-party servicers are heavily involved in the servicing for energy efficiency as well. So again, servicers manage this money flow, but there are variations on a theme. So what do I mean by that? Very often you'll hear, for instance, that a utility might have an on-bill program. So in that case, what's happening? The utility is actually acting as the servicer in that example, right? So the utility is doing the collection and managing the repayments. The utility is dealing with late payments. So in many respects, on-bill repayment or on-bill finance that you hear a lot about, the main difference is that you've got the utility sitting in that servicing role and position. What's interesting, though, is that as you start to move different types of players and functions into the servicing role, you can take advantage of the different roles and enforcement mechanisms that that a utility, for example, might have. So a utility is able to disconnect a customer for failure to pay the energy bill. Could they also be able to disconnect service for failure to pay the financing portion of that energy bill? That's something that people look at a lot. And I will say it's also something that very frequently utilities are either unwilling to do or reluctant to do or unable to do. But nonetheless, in some cases, it is possible for a utility to disconnect a customer service for failure to pay not just the energy bill, but also the financing portion of that bill. But again, significant caveat, because it's actually a lot less common in practice for that to happen. The next type of kind of servicing that I'll mention here is a tax authority. So this refers specifically to commercial PACE or residential PACE, where the servicer for at least part of the servicing is actually the local government or whoever that tax collector happens to be. Tax collectors have all kinds of ability to enforce their collection, and to the extent that a commercial PACE assessment is sitting on the tax bill of a customer, of a borrower, then that assessment can actually take advantage of many of the enforcement provisions that exist, which could ultimately be sitting on the top of or near the top when there's a foreclosure and where there's money that's collected via that foreclosure. So that's another type of enforcement mechanism. One thing I want to mention, and one thing that you're going to hear a little bit about through the discussion, is in all of these different structures, you're going to hear in some cases about debt, and you're going to hear about off balance sheet. You're going to hear about non-debt products and so on. And I mentioned that in particular in relationship to commercial financing, multifamily financing. And I want to spend just a minute referencing that and defining that. So there is I think the easiest way to define debt is when a capital provider has an agreement with a customer, and that customer is obligated to make that payment come, and the phrase is to come hell or high water, right? It's a hell or high water payment. So in other words, that payment is not dependent on reaching energy savings goals, for example. The repayment is required no matter what, and a failure to pay results in default. You're going to hear about energy services agreements where the payment, that repayment, is actually based on meeting certain goals, meeting certain milestones as far as energy savings goals. So you're going to hear about that. You're going to hear about commercial PACE and some of the specific goals or the commercial PACE interaction with is it debt or is it not debt? But as a tax assessment, many people would argue that it's not debt, and that is valuable if you are a commercial borrower. So I wanted to mention that as kind of a last item here. So I'm going to stop here and see if there are questions at this point. I wanted to keep this part of the presentation to 30 minutes, and I wanted to see if there are questions at this point. And if we will then we'll move on to the next presenter if not. But I'll leave it either for Jensen or for Nick. Are there questions?
Yep, and thank you, Matthew. So starting us off, Mike from NYSERDA asked a great question. How do energy savings, equipment, and other non-credit attributes factor into underwriting?
That is a great question. And I think if you go back to the underwriting kind of discussion, right? For some, and it really depends, first of all, on the market sector, and it depends on the capital provider. So you will find many banks and credit unions will really only take they'll take kind of a cursory look at energy savings, and they will say, oh, this is good that this project has positive cash flow based on energy savings, right? But they may ultimately really only look at whether that project is sitting with a creditworthy borrower. But there are times, and we see this a lot in different types of capital providers that we work with. We see that in many cases, positive cash flow, energy savings is going to push that project kind of over the edge. In other words, over the edge into a positive way, if you can associate positive cash flow with a project. However, there are other types of project we work with, and you'll hear about energy service agreements. Energy service agreements depend very much on that energy savings, or certain types of commercial PACE depend very much on that energy savings. There are residential kind of service agreements that also depend very much on that energy savings. So it really depends on the capital provider. It depends on the particular program that's been set up. But I think we're seeing more and more kind of consideration of energy savings.
Great, thank you, Matthew. And then a couple other notes. Someone asked if we will be sending around a copy of the slide deck. I just want to note that not only will a recording of this presentation be provided, but we will also provide a copy of the slide deck. Yes, there. And then Jeremy Karen of the City of Des Moines asked, about what kinds of mechanisms that support more inclusive financing, reduced risk, and help overcome financing efforts focus on low income and low credit customers. Matthew, I'll let you comment on that if you like, but I also want to note that Kim Stevenson of Inclusive Prosperity Capital will be addressing this question in an upcoming segment as well.
Yeah, and I think that's a great question. There are there are just myriad kinds of ways to deal with lower credit or kind of on the edge types of credit customers. I want to maybe focus on a couple of kinds of things. First of all, I think it's important that we just kind of frame this when we're thinking about financing and serving low to moderate income or low to moderate credit kind of customers. We need to keep in mind that there's some customers who really shouldn't get financing, it would be a bad idea to provide financing to certain types of customers because they're not in a position to be able to pay that money back, right? And it would only hurt their credit. So I think it's first of all important that we not get focused on providing financing to everybody because financing isn't good for everybody. So that's number one. Number two, there are a lot of organizations that spend a lot of energy focused on providing financing, providing capital to low and moderate income household borrowers, to small businesses that may be in disadvantaged communities, to multifamily property owners that may be in disadvantaged communities. And so one of the things that you see is that, for instance, these CDFIs or community development financial institutions will provide capital, they'll provide loans, they may take alternative forms of security in those loans. That you will very often on the residential side see those CDFIs providing credit counseling and finance counseling in addition to providing the capital. So you will often see kind of that combination. You will often see also that there are specific community development financial institutions, community lenders who are very focused on providing capital to small business borrowers in certain areas. A lot of CDFIs will provide small business loans, but they are still managing their risk, and they're managing the risk often, not just by using this type of automated underwriting that I was describing earlier, but they're managing their risk by providing by taking a close look at the financials of those individual borrowers. So it's kind of a mix of specific capital providers and then providing specific services to those types of entities. The last thing, and I won't really spend any time on this, is you're going to hear from Inclusive Prosperity Capital and some of their approaches to this market with a particular emphasis on the multifamily side of things. You're going to hear from them that they will focus on offering a so-called non-debt product, as I had just mentioned, and they've got specific sources of capital that are available.
Great, thank you, Matthew. And I believe that we have another minute or two for questions before we transfer to the next segment. So our next question is from Kelly Delaney. Thank you. She asks, how common are energy service agreements in the residential sector?
I would characterize them as emerging. And there are a few out there. There's Sealed, which is a New York-based company, provides an energy service agreement. But one of the things that I think this is one of the kind of the issues with it, or barriers sometimes to energy service agreements in the residential sector, kind of goes back to the size of most loans. So an energy service agreement often will rely on energy savings and an estimation of energy savings. And in order to come up with good estimates to verify those energy savings, it costs money unless you're only going to use deemed or expected savings amounts. So it can be hard to develop that type of structure, given the fact you've got on average $8,500 loans for most energy efficiency retrofits. So there are companies that are doing this, and there are companies that are having some success, but it is certainly it's an emerging kind of product. So might be something that Peter Chrysa might touch on briefly in his remarks as well.
Great. And I will also note that as Nick from ACEEE just noted in the Zoom, that there's actually a presentation later today at 2:45 Eastern on the called Residential Energy Loan Program, and Sealed will also be presenting on residential ESAs. So a great opportunity to learn more there.
Yep.
Matthew, I believe that is the end of your time. For anyone else who had questions, I'll try to answer them in the chat, and then we'll also put Matthew and my own email again. Should anyone have any follow-up questions, please feel free to email us and reach out. We want the education to continue beyond today.
Thank you, Jensen. I'd like to introduce Peter Chrysa. Peter and I have been friends for many years, and a few years ago cooked up this idea of founding the National Energy Improvement Fund. And Peter has a long background in working with energy efficiency finance programs, and in particular focused on residential energy efficiency financing. Knows more about this than I will ever, I don't know if this metaphor works, than I will ever forget. I'm not sure, but I'm going to turn this over to Peter to take over, and Peter, as with the other speakers, is going to talk for about 7 to 10 minutes, and we'll have some time for questions after that. So Peter, take it away. I'm going to turn off my video and I'll let you talk. So Peter Chrysa, have at it.
Thank you, Matthew. And I just texted Jensen. I said, you might be up for, he's doing such a fine job as a moderator. He may be a great contestant to be the next host of Jeopardy. So I'm hoping Jensen will put his hat in the ring there for that. But so Matthew and I, as you said, have worked together for a long time in this whole space. And one of the things we've learned, whether it's through NEIF or all the programs that we run through, is this confluence of altruism. We all want to get the right stuff done, and pragmatism. How do you get it done? And I'll focus on my experience in residential stuff because, again, it's there's energy savings goals and program goals and everything else. But if it can't go to market, how do you make it go to market? Just as a background, very quickly, prior to joining Matthew with NEIF, my company AFC First established most of the leading residential financing programs around the country, from Keystone Help to the Illinois On-Bill program to Connecticut On-Bill program. So we have lots of experience with hundreds of thousands of loans in this space, and what drives uptake and what drives program uptake. But very simply, home energy efficiency resilience upgrades can be expensive, and these are not numbers that are unknown to you. It's the average efficiency improvement is around $8,500, depending on the scope and scale, but it's a pretty big number. So next slide, Matthew. So but they are unexpected or generally low priority for homeowners, despite we in the space saying, gosh, you should really upgrade your energy efficiency, or you should do more resilience. It's not high priority for consumers, right? It's not part of their planned budget, unless they're the small percentage of truly green customers who really are into this, or early adopters that are doing great things. Most homeowners would rather invest in a new kitchen or landscaping or whatever they have to do than replace their furnace or upgrade their heating or insulate their home, that's why fair, affordable financing drives the success and adoption of all kinds of measures. This is a statistic from a variety of studies going back to when we were a Fannie Mae energy lender 20 years ago, to even a recent Harvard study. But 60% of all energy efficiency measures residentially are financed one way or the other. So that's a home equity line of credit, a credit card, a program loan, a market-based loan, whatever it is. So it's a giant part of the market. But most of those kinds of numbers, like this $8,500 number, just think about all of us as consumers, falls into this weird twilight zone. It's too big to pay cash. Like, oh, I have to, my heat pump just blew. I don't want to write a check for $10,000 or use a credit card because that's going to exceed my balance, or I don't want to do that. But it's too small to go through going to the bank to get a home equity loan or go through the whole process because I really need this today. And that's a 2-week process. So, if you already have one, great, that's great, but it's a really cumbersome process to go to an external place. So this is all driven by point of purchase financing. That's why simple point of purchase, low monthly payment programs drive the success of most programs, almost like auto financing. We saw this with Pennsylvania's Keystone Help program that we developed with Pennsylvania Treasury 15 years ago. It was all about lower long-term monthly payment financing like auto finance that you could pay off whenever you want to, versus promotional financing. That's what drove deeper retrofits and more program acceptance. Matthew, next slide, please. So, oh, I don't see my little graphic, and oh, there it comes. I see it now. Click all the way through, Matthew. Apparently this is all very clickable here. So if you think about the 4 quadrants of home improvement buyers, right? And it really does break out to this, like 25% of the market says, I'm just going to pay you cash, or use my home equity line of credit, or I'll use my credit card to get my points. Or down in the bottom, which I think this is kind of an insidious and diabolical thing that we're all going through right now, is this 0% promotional finance stuff that we see really heavily promoted in the auto finance industry or in other spaces. Like, okay, I'll use your free money if you give it to me. Why wouldn't I do that? But I would have paid you cash anyway. That's for like the typical 12 or 12 month 0%, and then it's 36% thereafter. That's one version of 0%. The other version of 0% is, we're seeing this in auto finance, and we're seeing this more pervasively, and I use that word in a pejorative sense, in the HVAC industry, where it's 0% for 5 years. Do you know what 0% for 5 years costs a contractor if it's not a program? 15 or 20% of the deal price, because obviously there is no such thing as 0% financing. So somebody's got to pay that delta. So a contractor is saying, I'm doing a $10,000 job, and the finance company is saying, great, we'll do 0% financing, but you have to pay us 15% of that job. We're going to discount your payment by 15%. Where do you think that's going? It's going into the price somehow of the deal to the consumer. So I'm very concerned about that. As NEIF, we're very concerned about that market, but it's what's out there right now, and a very substantive competitive thing. Then you have the credit challenge buyer, and we alluded to this in some of the questions about, okay, you have bad credit, you have inability to pay. Low income and bad credit are not, maybe I'm going to use this term incorrectly, but they're not mutually exclusive, in the sense that we have a history through hundreds of thousands of loans saying low income people pay their bills and they have good credit. That doesn't mean that they're bad credit risks by low income. It means that we're more concerned about overloading them with excessive debt that they can't afford to pay given a limited income. So we have to be very careful about that, about not putting people in a position of, as Matthew said, about being unable to pay debt that they can't pay. And so when you see a lot of this stuff, and a lot of the stuff that happens with residential PACE was all based on that, was, what are the crisis issues right there? It was like, okay, the lady, the person on senior, citizen on fixed income was putting a $40,000 solar system on their house using PACE that they ultimately couldn't afford to pay back. That's just not, the right thing either. So there's this balance again of altruism and pragmatism. So finally, the monthly payment buyer is the other 25% of the market, like the auto finance market. Like, okay, I just want to put in a high efficiency system. I want to pay X dollars per month. I want this to work. And how can I do that? So those are the quadrants you have to address when you're thinking about a program. Matthew, next slide. But again, the reality of the world, it's all based on keeping it simple for consumers and contractors, because the number one influencer in all these programs residentially is the contractor. Again, nobody wants to replace their heat pump. Nobody wants to think about, like, what's the best deal for me? What's the most energy efficient deal? They call their 3 contractors or 1 contractor, and that person comes to their house, and they are the main influencer of the consumer's energy decision to improve their home. And a program success, and this goes back to all the programs that we have run historically, is based on building a secure, quality contractor network. So it's all about the recruitment of contractors that get it, that they're financially and ethically stable, that they're vetted for that they're not allowed to participate in your program unless they are, and they're consistently trained on the program and integrating the sales process of the program into what you're trying to achieve. Most successful contractors are extremely effective at integrating financing into their sales process. It dominates the whole world right now. That's the typical high quality contractor does that. You have the little guy who may not even think about it. You have the duplicitous contractor on the far end that we don't want to deal with, but core good contractors are making financing a part of everything they do. They're also making rebates part of everything they do. What can I do to offer my consumers the best option? but they're looking for the path of least resistance. They want the fewest complications to their sales process. They want the lowest cost to them, and they want the greatest benefit to their consumers. So the path of least resistance, and we have seen programs fail that were well-intentioned, but it involved, okay, everybody's got to get an energy audit, and that's going to take 6 weeks to get back to you. And it's all really good, but if a contractor is not going to get paid in a timely fashion on their job, they're not going to use and promote the program. As I mentioned before, contractors can pay huge fees for market-based financing in order to offer attractive interest rates to the consumer, but they really are looking for better alternatives, and that's where program management comes into place. Also, this transference of credibility, where it's a utility program, a state program, that's really important to a contractor. We as the NEIF, our NEIF seal of approval is a big deal to these guys because, we're a B Corp, we're a legitimate, energy financing entity, and they're approved by us. Same thing if they're offering a program through the Pennsylvania state program or the Kentucky state program or the Illinois state program. That's a transference of credibility that makes the consumer feel more comfortable. So don't ever underestimate that whole marketing tie-in. But a program has to achieve its goals. The only way they can do this is by aligning contractors that get it, that offer a low payment, better than market rate program. So you have to say like, well, I could do this, or I could do this at this rate, and there's no contractor fee to me, or a very low contractor fee, because I'd be paying a finance company 5 or 10 or 15%. Wow, I can offer your program for no fee. That's right into my pocket because these are profit motivated people. Most importantly, without overcomplicating the sales process, keep it simple. How do you make this in a everything you do right now, we're all consumers. It's about instant approval, eDocs, simple metrics. Like, how do you develop a system that can do all that? Because if you have a cumbersome paper-based product, or process or anything like that, it won't get uptake at all. If you do those things, those contractors will become the primary sales driver for a successful program. So, if you want to drive program uptake, it's about designing a program that appeals to consumers, but probably more importantly, appeals to contractors to offer it. And then beyond that, have the system in place to vet those contractors for their financial and ethical stability and their ability to deliver the program. And then beyond that, have the ability to train those contractors on how to sell and integrate those programs.
Peter, thank you very much. That's great. You did a nice job with kind of keeping right within the timeline that we were looking for. So, do you want to spend just a minute, Peter, talking about what you've seen with kind of the debt versus non-debt, and maybe or products for the sealed types of products, and do you have any perspective on that, and whether that's likely to be a big part of the market, or whether it's going to remain kind of niche? What's your sense?
I think it's a great idea. As we sealed, as you mentioned, we'll be presenting later, and Andy Frank has developed a fantastic model. It's just, again, about you're creating a new vehicle that a consumer and a contractor has to learn how to accept. So I don't think consumers or contractors view any of this stuff probably with the sophistication that we might. But if you think about car leasing, you go back to the auto finance industry, how car leasing became a thing. I don't know, 15 years ago was never a thing, right? But now it's a thing. You go buy a car. Oh, do you want to finance it or you want to lease it? Do you want to rent it? Volvo has a rental program. Like it's just a financial product, right? So an energy savings agreement is just a financial product that requires education to the consumer. So I don't think, on the small side of stuff we're doing here, these $10,000 improvements, I don't think the impact of energy savings really impacts people's financial decision too much, frankly, because it's all kind of small, right?
Mm-hmm.
Now, if you're talking about major changes, so it comes down, Matthew, more toward education on the understanding of a financial product and people feeling that they've been given transparency and not duplicity. And I think,
right.
That's my thought.
Yeah. You with AFC First, you had you had noted that, or you worked with, you created the Keystone Health program, which was kind of interesting. If you go back to the kind of structuring discussion that was in my presentation about having different types of capital engaged, whether it's state capital or whether it was, just different types of funding. Can you talk just a little bit about the role of Pennsylvania State Treasury and their perspective on this, the role of foundations, and then also kind of the evolution where you see models like that moving in the future?
Well, I think there's two ways that you have investors, and this is how Pennsylvania Treasury always viewed this. We have $8 billion that we have to invest somewhere. We would like to invest it in, obviously, most of their money into traditional vehicles, but they also want to invest it into something that may be mission-based, that can do good things and get them a return. That's all they really care about. What's my return? What's my risk? Like any other investor. Are we willing to accept a slightly lower return and a slightly higher risk if we're doing something mission-based? Yes, for a certain portion of our portfolio. So I think that's where Pennsylvania Treasury came in. They were very innovative. Bob Casey, who's now Senator Casey, was the treasurer. Keith Welks, who's been kind of my Yoda in all this for many years, was the deputy treasurer. And they were able to carve out a small piece of that to say, we're going to provide the capital for this at a lower interest rate than you can get from conventional lending sources. It's the same kind of foundational capital that comes from anybody that says, yes, we're willing to accept a slightly lower yield to achieve mission-based goals, but we're not stupid. We don't want to lose it, right? We want to get our money back. So help us with the underwriting guidelines to do that. Then you compare that with other state agencies or like potential federal money that can provide loss guarantees or other backstops that allows us to move into the private capital market. And so, yeah, we like this stuff, but we need to get this yield. But oh, wait, the state's backstopping this with a loss reserve. That's good. We can take a lower yield. All that translates to a lower rate to the consumer. So I think if you overcomplication is the death knell of all this stuff. You view all these people as people want to make an investment, they want to get their money back, or they don't care about getting their money back. They just want to do a good thing. And so if you put these people in little buckets, you can combine it to make a better and more effective program.
So last question, Peter, I quoted you. I don't know when you joined, but I quoted your dad, and in a often quoted remark that you have often said, which is, a loan well closed is a loan half collected, right? Yeah. And I love that quote. And how do you, if you kind of think about that, what does that mean? How do you apply that to this kind of residential energy efficiency world where you've got to have the efficiency, the speed, and so on?
So I think if you go back to our historical performance, Matthew, that you're well aware of, we look at, hey, we made hundreds of thousands of these loans, and our delinquency and charge-offs based on this all goes back to the original Fannie Mae metrics from 1999. But if we apply certain credit standards to these loans, they perform better than general consumer loans with the same credit standards. Because these loans have been made for energy efficiency improvements, they're going to perform better than loans made for hot tubs, right? So, well, why is that? Like, what's the deal on that? And I think part of it is the nature of the investment, that people are more serious about their HVAC loan than they are about their hot tub loan. I'm speculating here, or their credit card. I think the fact that they're fixed term loans is really important. When we did attempted to do some revolving debt credit card financing, which is what you'll see from most home improvement stuff, is all revolving credit stuff, that delinquency is inherently higher than fixed rate, fixed term loans. So you have that performance issue. Then the other, loan well closed. So you have the basic standards. Then, great, I have a product I really want to get. I'll pay you back in a term that I understand my terms. I don't feel like I'm going to get jerked around, because all of us have these credit cards that say, oh yeah, my credit card's a 699 credit card. It's not. Your credit card is a 699 credit card until you don't make that payment on the 31st day, and then it's a 28% credit card. So look at all you guys look at your agreement with American Express or anybody else. That's your agreement. If a loan is in fact going to be 699 for the term, no matter what, it's a higher likelihood to get repaid. Then finally, the delivery by a contractor network that's vetted, that this is the loan well closed part. It's like, I'm getting an improvement from a contractor that I trust for a good thing. I'm going to pay that back. So I think those things all make a difference, Matthew, in terms of the efficiency and the effectiveness of a program.
Great. Okay. Well, Peter, that was terrific. Thank you. And I'm going to I'm going to make a small deviation from the original agenda just to get we're still I'd said that we would have Charlie Lord speak, but if I could just make sure that Mike Doty, are you with us? And make sure that you're unmuted.
Hi, Matthew.
Morning, Matthew.
Charlie Lord. Sorry.
Oh wait. Oh, Charlie, you're there. Okay, we were somehow I was showing you as not there. So, okay, that's good. Lovely. No adjustments necessary again. So, but Mike, I'm glad you're with us, but I'm going to ignore you for the moment. So
Thanks, Matthew.
Happy to do it. So let me just, I'm going to introduce Charlie Lord. And while I stop my screen share and Charlie brings his up, sometimes we joke in this world, it's kind of a small incestuous world. I will tell you that I think all of us who are on this call have known each other for, or at least I've known them for some number of years. And so I'm happy that Charlie is able to join us. We are working with Charlie on a number of different areas that he may refer to or may not. But I'm going to let Charlie do a self introduction. But he is here to talk about energy service agreements, a kind of non-debt type of funding product. And I'm going to say one of the first things that Charlie may quibble with is even the name of this energy efficiency finance conference. So I'm going to leave that to Charlie to quibble with or not as he likes. So Charlie Lord, take it away.
Thank you, Matthew. It's great to be here. Can everybody hear me okay?
Yeah.
Okay, and you can see my slides now?
I could for a second. Are people able to see those slides?
Yes, Charlie, I'm able to see your slide.
Okay, excellent. Well, again, great to be here. Obviously a huge fan of the organization and was very pleased when Matthew invited us to join as part of this educational event. Renew Energy Partner, I'm a principal and co-founder of Renew Energy Partners, which is one of a number of firms that offer energy services agreements. And I'm going to walk through the sort of basics of the energy service agreement approach to funding energy efficiency retrofits. Many of you are probably familiar with it as a vehicle. As Matthew said, we use the word funding, not financing, because the entire approach is designed as an alternative to traditional financing. And there are some key features to that and some benefits to that, which I'll emphasize. But I will give this quick overview and then leave plenty of time for questions and look forward to answering those questions. The Energy Services Agreement came into being really to address what at Renew we call the principal roadblocks to efficiency retrofits in commercial, industrial, and institutional portfolios. And that is often that what we call capital and complexity. Building and portfolio owners of all sizes, and we have case studies in the Fortune 200s that just simply have competing demands for the capital budget. And because of that upfront capital cost to implement efficiency upgrades, often these projects get delayed and pushed off year over year, and many of them are complicated. And so having a dedicated partner can be really helpful as well. So the Energy Services Agreement is designed to eliminate that capital hurdle primarily, and also to make these projects easier to implement and more comfortable for portfolio owners to implement. So in short, the Energy Services Agreement provides a funding option to provide the capital funding for the project. And it's designed to, and in fact, in order to get service treatment, which I'll talk about in a minute, it is linked to rigorous measurement and verification of these savings. By design, an energy services agreement is a long-time service partnership. So it comes with a partnership that isn't responsible for maintenance, is responsible for operating projects, and so addresses that complexity hurdle as well. So essentially, the crux of an energy services agreement is that the efficiency upgrades to a portfolio or a building are funded with future energy savings, and so the energy service agreement provider, of which Renew is one, provides the funding to design, build, operate, and maintain the systems. And in fact, under the energy services agreement, the funder owns the systems for the term of the ESA. ESA providers seek to create projects with their design build partners that deliver savings to the building owner net of the payments to Renew. So in other words, each month after the project has been commissioned and for the duration of the contract term, customer is making payments to the energy services agreement provider out of those savings and keeping some of the savings for themselves. I like to say to customers, particularly to CFOs, your return is infinite. For no upfront investment, you see a reduction in your operating expense. And then at the end of the agreement, the site owner takes ownership of the systems. As for almost every energy efficiency upgrade, the value of the equipment is in salvage is less than the cost for us to remove it. And so what energy service agreement providers like Renew usually do is simply transfer the project over to the owner at that point, or the owner can roll it over and do an additional efficiency upgrade. It's important to note that under the lease accounting treatments, the determination of that energy services agreement, final buyout and final disposition has to be left until the end of the term of the contract. Otherwise, it looks like an operating lease. So, typically an energy services agreement must include greenhouse gas emissions reductions. That's easily accomplished for any efficiency project, obviously, as all of us on this call know. We have found at Renew, and I think other firms have found the same, is that that in order to make these work, because there's this third-party funding mechanism and certain administrative costs associated with that, the projects need to be over about $250,000. Now that can be reached by aggregating projects across an entire portfolio, but each customer relationship needs to be at about that level. In terms of why customers choose ESA, as I said, it's designed to address the hurdles of capital and complexity, and it is very much distinct from a capital loan, a lease, or some of the other financing options that are available to fund these projects. To the extent that a portfolio owner has competing demands for the capital budget, or does not want, for one reason or another, to take on additional debt, then the ESA is a good option, because it's obviously not going to dip into the capital budget, and nor does it represent debt under the traditional context. Because it's structured as a service agreement, which requires, under the lease accounting rules that went into play in 2019, that include the fact that the savings has to be measured and verified. It's not on the balance sheet, whereas leases are on the balance sheet. So that means that for a customer that is tracking how much they have in the way of debt, these are service payments. They're not showing up as debt on a company's balance sheet. And in addition, because it's a service treatment, the energy services agreement provider is doing all of the operations and maintenance during the term, and it provides an architecture for a customer to do additional projects, to add scope, to add buildings. It's a long-term partnership for doing energy efficiency projects. I'll quickly wrap up by talking about some of the challenges to energy services agreements. Often customers will feel that it's too good to be true. And so we have to walk through, the benefits, and also the challenges of doing an energy services agreement. Understanding this financial treatment and confirming for a CFO that this is indeed off balance sheet is one of the challenges. We've obviously developed a significant amount of material on that, as have others in the space. And then finally, often the energy services agreement will flag for a portfolio owner the potential benefits of energy efficiency projects. The CFOs are often tempted to then self-fund, but in almost every case, when a CFO says, I'll pay for this myself, those savings look tasty, they don't do it. And if you get out a year or two, the energy services agreement third-party approach is much better. And finally, to wrap up, most ESA firms are going to market through a variety of channels. Renew, for example, we have a direct-to-customer program in certain sectors. We are in the process of finalizing partnerships with a couple of utilities that are looking to provide an energy efficiency as a service option to their customers. And then we go to market through design build contractors who are putting together energy efficiency projects and then want to have the ability to say to their customers, here's a way to do it without dipping into your capital budget. So I'll stop there and look forward to answering questions. And again, very happy to be here. And thank you, Matthew, for including us.
Of course. Just a note to all of the participants that you should feel free to put any questions that you have in the chat. I've got a couple that I wanted to just start us off with that are coming in. One is a quick question. We're going to hear next from Mike Doty with Greenworks Lending, and there are in some ways, I guess, the ESA and commercial PACE have maybe some similarities, and Mike might want to comment on this as well. But would you mind taking a minute to comment on kind of how ESAs, energy service agreements, fit into the world of commercial efficiency funding, and how that might compare and contrast to a commercial PACE?
Yeah, that's a great question. We are obviously here at Renew thrilled to see the momentum generated by the PACE programs. The obvious difference is that the PACE payments are, as Mike will get into, added to the tax bill. That creates significant additional security for these payments. Energy services agreements payments are unsecured. They're not linked to the building in any way. The PACE programs now, many of them include a lender consent component, and sometimes lender consent can be difficult to achieve, in particular if you can't find the lender, as is the case where a building is part of a portfolio where the mortgage has been securitized and sold on. That's just one example. So the ESA and PACE are two options for third-party funding. Both of them are excellent, and each of them applies and is most effective in certain case-specific situations. One quick observation on this point, which is that Renew has long worked with the Connecticut Green Bank, which has a very robust PACE program. And in our conversations with them, it does seem pretty clear that over the first 3 to 5 years of that program, for every dollar that was available to PACE, every project that was available to PACE, there was equally a project that for one reason or another was seeking third-party funding, but didn't or couldn't qualify for PACE. So in our view, a robust marketplace for third-party efficiency funding will have ESA and PACE programs side by side in every jurisdiction.
Great.
Great. And thank you, Charlie. And we have another question for you from the chat. Will energy services agreements address building envelope upgrades or only equipment upgrades?
Yeah, that's an excellent question. And actually, the answer, the top line answer is yes, but there's more to it than that. An energy services agreement project can include as much scope as the building owner wants to include, that has, and touch on this and come back to it. It could even include components that don't necessarily have direct energy efficiency benefits. As I said, for Renew's sake, because of our funding base, every project as a whole does need to generate greenhouse gas emissions reductions. Now, with respect to building envelope, as everybody on the call knows, typically those paybacks are longer, right? A window project might have a 20-year payback. It is possible, and we've done it in some projects, that the savings on the LED lighting component, which has a much quicker payback, plus the rebates are such that we can actually get the windows piece in and still deliver some savings to the customer. So at any project could include building envelope. And in some cases, if the incentives are right, it could even still deliver savings to the customer. Here's the other thing. An energy services agreement can, and in some cases, if the customer chooses it, will include payments that are slightly higher than the savings. We have a master energy services agreement, for example, with a Fortune 200 that is really dedicated to eliminating carbon emissions on an annual schedule. And they are rigorous about meeting their carbon emissions reductions goals year over year. And so we have done projects with them where the savings are not quite as much as the payment, so that they could reap additional benefits on the carbon side with longer payback items, such as building envelope. So that's a long answer to your question, which essentially is yes.
Charlie, another question. If the performance does not meet goals, are the payments reduced? What happens if the energy performance does not meet goals?
Yeah, that is a great question, and the short answer is yes. If the project doesn't deliver the savings as advertised, then the energy savings payments are reduced based on the M&B, and that is a crucial component of getting service treatment under the accounting rules.
Okay, another question: how high do electricity rates need to be to make ESAs viable? I've heard that low kWh rates are a major barrier to taking ESAs to scale in areas with low rates like Washington State.
Correct. In short, that's correct. Yeah, unless there's incentives to boot, the ESA is really most effective in about 20 states, which have, the top 20 states, which have the highest electricity rates.
So are you then active or nationally, or are you able to, do you keep kind of stay out of those other markets?
Well, it's a great question. The answer is we are active nationally, and when a building or project in a low energy, and we can do projects and make them work in the portfolio context. So for example, we're looking at a project now, doing final contracting for 3 properties for a portfolio owner. 2 of them are in California, where this works brilliantly, and 1 of them is in a much lower cost state. But when you bundle it, they're getting the energy savings, they're getting the cost savings across the whole portfolio, and they're getting the carbon emissions reductions, and we're able to make it work by dint of the fact that 2 of the 3 buildings are in California. But it's hard to make a standalone project work in a state like Washington. Yeah.
Right. Okay. Can you describe, if you can, kind of is there an ideal type of project or customer for an ESA? And also, as part of that, how would you deal with, kind of how you mentioned $250,000? How would you manage to deal with these kind of projects that maybe are 200 or 150,000? So how do you deal with smaller projects, and then is there kind of an ideal?
Yeah, because these are sort of third-party funded and owned by a special purpose entity, you have to get to a certain size, or the sort of administrative costs begin to really cut into the savings. Essentially, as the only way to deal with smaller projects is to bundle them. So a customer that has a portfolio of buildings and is doing $150,000 retrofits in each of 3 buildings, that's going to work fine. But a standalone $150,000 project is probably better will certainly better funded by a different vehicle, either PACE or straight financing.
Okay.
In terms of the ideal project, the earlier question points to some of the criteria. This is going to be a really great product in the 20 states with the highest rates. It's going to be a great product in buildings and building types that have higher usage, right? 24/7, 3-shift manufacturing, multifamily, hospitals, hospitality, warehouse and logistics. Candidly, we've looked at a lot of them and we can make them work, but commercial office buildings where it's a 9 to 5 and not at all on weekends, it's not as good a fit.
Okay.
Yeah.
Let me, Jensen has another question there. We're running up against time. So Jensen's one other question. There is actually one other one that I might, if we've got time, to go over by a couple minutes, but Jensen, go ahead.
All right, yeah. We had a question. Charlie, can you say more about protection for the building or owner? The ESCO industry has gotten some reputational stains for selling projects that aren't really advantageous for the building owner. How do you avoid that concern?
Oh, it's such a good question. And we've come into relationships where the customers have had frustrating experiences under an ESCO contract. And this isn't true of all ESCOs, by the way. I'm not denigrating the industry, but some ESCOs will have done a project and the customer will say, I never saw the savings, and then I had to claw them back. The difference between an energy services agreement and a traditional performance contract, which is I think what the question is referencing, is that under the ESA, in order to get service treatment, you cannot lock in the payments until you have monitored and verified the savings. So the protection to the customer is that we have to agree with them on an M&V protocol and then implement that protocol and deliver an M&V report, that confirms that the savings are there. Now, in a lighting project, that's less complex than in an HVAC project. But even in a lighting project, not in addition to counting the fixtures and multiplying by the difference in the wattage, we will do a data logging of run hours to confirm that the customer's sense of their run hours is in fact the case. And so the customer is protected because the energy savings has to be there. And there's an option. There are various M&V options under an ESA. The most expensive one, and it cuts into savings, but it's certainly available, is to require the energy service agreement partner to measure and verify the savings every year.
Okay, Charlie, a little puzzled here. We've got a bunch of questions coming in right at the end, and I think what we may do is try to collect those questions via the chat and hopefully be able to reach out to people after with answers. But I'm going to kind of take the liberty of Jensen, do you have one question that you want to select from the group that's that you want to put in front of Charlie, and then we'll make that the last question?
Sure. I think this is an important one for this conference. Is Carrie asks, what is the role of the utility in an ESA program?
Yeah, great question. And by the way, if you wanted to collate the questions and I'll try to answer them and get them back out to the group, I can do that too. Typically, we partner with utilities, obviously, in utilizing the incentives. The incentives can be used in 3 ways under these projects. One, it can go to the customer. That obviously means less savings per se in the out years, but it can mean a significant cash inflow to the customer in year 1 of the ESA. It can go to the contractor, which buys down the capital cost of the project, or it can come to renew as the project owner or the energy ESA provider, and in which case it flows into the project economics and it significantly reduces the payments and maximizes the savings to the customer. In terms of the utility partnerships we're talking with, those are typically around partnering on origination and offering these services to their customers who want to do efficiency but want an alternative to using their own capital budgets.
Very good. Okay. Charlie, thank you so much. This was great. I know that there are a number of questions that we were not able to get to, so I guess that's a good thing in many ways. But we are going to try to collect those questions and make it and be able to answer those questions directly, and we'll figure out how we can do that with Nick. The next speaker is Mike Doty. Mike is with Greenworks Lending. We have worked extensively with Mike and his various team members over the last quite a while, and Greenworks is one of the original or one of the most established commercial PACE providers, and is national. I'm going to let Mike do a short intro for himself and continue on. So, Mike, welcome to it.
Thank you, Matthew, and thank you for the introduction of Greenworks. Should allow me to, for the most part, skip the Greenworks introduction because that was great. As Matthew said, we are an organization that was founded in 2015, actually out of the Connecticut Green Bank, which Charlie had mentioned earlier. Our two founders launched the Connecticut Green Bank back in 2011, and by 2015, Connecticut was responsible for something like 50% of the CPACE originations nationally. And as much as I love my home state, anytime we represent 50% of anything, you've either identified a problem or an opportunity, and this was the latter. So Jessica and Allie spun off to create Greenworks Lending so that we could grow the lending platform of CPACE across the country outside of Connecticut. And we've grown from that point from lending in 4 states to now lending in just over half of the country, and completed over 400 projects with an overall value of about $500 million invested into the built environment across those 6 years of operation. So CPACE, what is it? It stands for Commercial Property Assessed Clean Energy. And what that is it's a mechanism that's a public-private partnership that allows for a public benefit assessment to be placed as a lien on any eligible commercial property for the benefit of energy efficiency or renewable improvements. And that might beg the question, why would you do that? Why would you go through the effort of placing a public lien on a building in order to fund these types of measures? And it's because it acts as a credit enhancement. It makes smaller private debt look very much like municipal debt, and that allows us to lend at rates and terms that are incredibly competitive and differentiate CPACE from other types of traditional financing mechanisms that are available in the marketplace. And it ultimately unlocks any energy project that has a positive economic return over its life can now produce a cash flow positive project for that borrower. So the benefits, relatively low cost, 5.5% to 6% rates is what we're seeing in the market right now. We're able to fund over the long term, so out to the effective useful life of any measures that we're funding. We're able to fund 100% of the eligible improvements, both hard and soft costs, inclusive of all the costs associated with actually providing a CPACE loan. So that makes it a zero out-of-pocket proposition for customers so that they don't have to go through that capital expense process. It also is flexible. So you're able to repay the assessment at any time. Some fees do apply if you go early. It also requires no ongoing financial covenants as other loan products might. So there's no interest reserves, there's no ongoing financial reporting. We're only secured by the lien placed on the property. And similar to taxes, that lien is completely non-accelerable. The payments that are due in 2028 can only be collected in 2028, even in the event that payments aren't made. So the only amount of money that a CPACE lender can enforce is what is currently due or past due. And that component, combined with the fact that it's non-recourse and doesn't require any personal or corporate guarantee, allows CPACE to be treated as off-balance sheet funding for the operating entity in most cases. So most commercial buildings, the way that they're set up is there's there's a holding company LLC that just owns the building, and all of the costs are passed through to either the tenants in a commercially leased scenario or to the operating business in an owner-occupied scenario. And in an owner-occupied scenario, the CPACE assessment will have the same impact on their books as taxes do. So they're not holding a liability. You don't hold your next 10 years of taxes as a liability on your business's books. You just pay them as an expense as they come up. CPACE can be treated the exact same way. It also can be transferred automatically upon sale. So we would have no say or involvement in the sale of a property in which we've created an assessment. Our payments would just simply be due from the owner of the property at the time that they become due. So if you sell the building and you've only received 5 of the 15 years of benefit of the project, or 10 of 25, whatever it might be, the future payments and future benefits transfer seamlessly to that new owner. It also helps significantly reduce your operating expenses. So in addition to energy savings, many of the projects that were funded are well past useful life mechanical systems that are an extraordinary drain on an overall operating budget, just trying to keep systems together with duct tape and a prayer. And ultimately, this helps solve one of the major problems in the energy efficiency space, which is trying to align the interests of the building owner, who typically is responsible for maintenance of their building, and tenants who are typically responsible for the energy that they're using within that building. So many times there'd be a great project to be had, but the owner who would need to make the upgrades isn't responsible for the energy savings or for the energy costs. So the savings don't mean a ton to them. The investment just doesn't make sense. A CPACE assessment can be passed through on most lease types to tenants, so that both the savings and the costs can be seamlessly passed through together, and the building owner out of the deal gets a more functional, more efficient, more saleable building, and the tenants get lower overall operating costs at the same time. So it really helps align those two interests to the greatest degree possible. As far as where this is available, this is a current map of where CPACE laws have been enacted. You can see it's really covering most of the major municipalities at this point. Most of the major cities are covered by CPACE or will be soon. The newest additions to this map, if you might have seen one a year or two ago, Massachusetts is now on the map, Florida is now on the map, that's relatively recent. Oklahoma is now on the map, and the newest ones coming on board soon, Washington, Alaska, and New Jersey are also exciting opportunities. As far as what types of things we can fund, it's really anything that touches the energy use of the building. So building automation, HVAC systems, LED lighting, domestic hot water, VFDs on those domestic hot water systems or on the HVAC systems. In many jurisdictions, we can also fund water conservation and resiliency, and we can also fund building envelope. And not all CPACE programs require that the savings outweigh the cost over time, which allows us to do building envelope improvements that may have longer paybacks, and the economics might be tough in many jurisdictions. The use case for this and sort of who it works best for, multifamily, hotel, and hotels are really probably our 2 largest verticals, followed by office. This is one example of a redevelopment of a hotel in Texas that we did a couple of years ago. We were able to fund lighting, HVAC, and elevator upgrades for 20 years. Ultimately, we're funding about $9 million of capital expense on a total $77 million renovation. And we're able to contribute about 21% of the capital stack on this redevelopment. Another powerful use case for PACE, which many folks on the line may be less familiar with. So when major redevelopments are happening, a lot is going into that. And there are usually multiple capital sources. People are taking money from historic tax credits. People have a senior construction lender. People have equity investors. And there may also be a mezz or preferred equity piece, financing term. And CPACE is really pushing out preferred equity and mezzanine debt at much lower rates. The importance for that for the folks on this call is, new construction and major redevelopment is a really tough market to touch because of all of the things going on, and developers, typically speaking, aren't looking at the long term when they're making decisions. They're trying to get a building stabilized and cash flowing as quickly as possible. And utility incentives available for new construction are great based on incremental cost, but that whole amount of money just doesn't add up to really an impactful number for an owner. And so oftentimes energy efficiency improvements that could be included are getting value engineered out. PACE can help provide 20% of the money needed to do that entire development. And, in that case, we're talking about a much more impactful amount of the money needed to make the project happen, coming and directly tied to the energy efficiency and the energy performance of that building. And PACE is a really powerful tool to bring energy back to the forefront, help a project get done that might not otherwise be done, reduce the overall cost of the capital required for that project, while also driving energy improvements to that building. So that's one of the sort of probably between 30 and 40% of our business now is new construction or major gut rehabilitations of buildings and funding energy efficiency measures within those larger construction projects. Another great use case for CPACE is also solar and renewables. We're able to fund 100% of hard and soft costs related to solar over typically 25-year life. You can pick a shorter term. In one example, this is a Connecticut project that we did. Building owner opted for a 15-year term, which aligned with the ZREC incentive program at the state of Connecticut, and funded just south of $1 million. And net of payments, lifetime savings for the building owner was $1.3 million. So a really powerful case study. And then, just to recap, so the overall advantages of PACE, you have what we think is a great partner in someone like Greenworks Lending. We're the largest CPACE provider across the country. We were the first firm to securitize our asset class, and have been many folks on our team were the original authors of state policy across this country. We also have a really streamlined underwriting process to get through these projects, and we're able to get CPACE projects down to $200,000. And that low end of the market is not well served by most CPACE providers. We're also lending directly off of our balance sheet, and we're going to service those loans throughout their life. And ultimately, where CPACE fits in the market, because Charlie talked about this quite a bit, it's probably not the best solution for the Fortune 500s. Their buildings are typically held in complex debt instruments, whether it be CMBS, securitized mortgages, or bond offerings in some way that make lender consent, something that Charlie brought up, a little bit difficult. Their internal cost of capital is also generally lower. So the cost of CPACE doesn't work. Where we're really finding our niche is in that second tier down below the Fortune 500, property owners that might own 20, 30 buildings, but more of a family office environment. Those folks have the scale to really take advantage of CPACE and have it drive to the bottom line, but their existing debt isn't quite as complicated, and their cost of capital from other sources is a little bit higher. So CPACE is a really good fit in that environment, and definitely want to leave some time for questions here as well.
Thank you, Mike. One question for CPACE. We have talked locally about trying to recruit community banks to help finance smaller projects, $25,000 to $100,000. My understanding is that regulated banks may be prevented by their underwriters from financing projects tied to a property versus a person. For example, let's say they are not able to loan money to someone on a terrorist watch list. Because PACE financing goes with the property, the bank has no control of the owner if a property is sold. Could this type of regulation hinder local banks from participating in CPACE?
So it hasn't in other markets. When you make the loan, we're subject to that same compliance of reporting. I wouldn't think that future ownership of the property would technically be an issue for a smaller bank, because it hasn't been. And there are a couple community banks in Rhode Island who are active, and I know there's a couple in Colorado who are fairly active as well. So there's obviously a way around that. I think that where those smaller projects become difficult more so than anything is the technical and administrative hurdles with PACE are relatively significant. And the use case, if the PACE process is going to cost 10 grand to complete, let's just say that that's the lowest sunk cost you can get it down to in a given municipality. If you've got a $40,000 project, there are just easier ways to access $40,000 that you're not going to incur $10,000 of dead weight. And no matter the bank, no matter the institution, that's tough math to get around. The way most community banks have been able to make this work is they're typically offering CPACE alongside a refinance of a first position mortgage. So if they're providing a $100,000 CPACE assessment, they're also refining a $300,000 mortgage. So they have $400,000 of debt to help defray some of those upfront costs and make the economics better for the end user. And I think that if you're trying to recruit local banks to service the smaller projects, you really want to look at it as a mechanism to increase their mortgage balance sheet more than anything else.
Great. Jensen, you've got another question for Mike?
Yeah, we got a question, Mike. If property owners can get 100% financing for solar, why would they consider any other financing option? Or put differently, what would be a case where PACE would not work for solar financing, but another financing solution would?
Sure. So the biggest one we run into is grid scale solar. Our underwriting is tied to the asset value of the commercial property, and we can lend up to 35% of the as complete value of that property post the solar addition. So if you're trying to put in a couple megawatts of solar into a field, it is unlikely that field is going to have enough value in it to allow us to lend the full value of the system. It's just, you're not, that 35% math of the as complete value of the system isn't going to work. So in that case, you're definitely going to be looking for other funding. As far as why other folks turn away, as Charlie mentioned before, sometimes owners, particularly smaller owners, may see the benefits of a solar system, and cash is, they'd just rather not pay interest and take all of the benefits themselves, which is great. Or it may be a situation where a tenant wants to put solar on a roof, and landlord, while they can do it, doesn't want to be a part of it, or they don't want to go through that structure of creating an agreement with their landlord to utilize CPACE. They'd rather just have a lease agreement for the roof, and in that circumstance, they'd have to use another mechanism to fund the solar as well. So I think those are probably the three areas where PACE wouldn't necessarily be a fit.
Okay, great. Mike, thank you. This is terrific. A good, very thorough presentation. Good answers to questions, and appreciate it very much. We have probably 3 or 4 more questions that, as with the last time, given time constraints, we're going to send those directly to you. And we're going to transition to our next and final speaker, which is Kim Stevenson with Inclusive Prosperity Capital. And Kim, as with the others, I've known Kim for actually quite a long time and worked together in her previous life at the Connecticut Finance Authority, which became the Connecticut Green Bank, which she, and then of course now with her work at Inclusive Prosperity Capital. So Kim, I'll let you take it away.
Thank you, Matthew. And can I just ask, can everyone see my screen and the slide? Yes. Okay, yes. Great, super. I'm going to be talking about harder to serve communities. I'm Kim Stevenson. I'm Director of Strategic Initiatives at Inclusive Prosperity Capital. My work is focused on collaborating with various partners to bring our financing solutions and products to the markets that our partners serve. The Connecticut Green Bank's name has come up quite a bit throughout the session today. I was formerly with the Connecticut Green Bank, where I led design and implementation of the Green Bank's multifamily programs, primarily focused on serving low and moderate income residents. Inclusive Prosperity Capital, who are we? We're a not-for-profit financing intermediary that's spun out of the Connecticut Green Bank. We invest in organizations, projects, and community initiatives to help scale the adoption of clean energy in traditionally underserved markets. We operate nationally. So we spun out of the Connecticut Green Bank because we'd achieved some success in addressing underserved markets, low and moderate income markets, single family residential, multifamily, solar markets, and saw an opportunity to take that to scale across the country. And as you all know, financing needs scale to be financially sustainable. Connecticut's a small market. Underserved markets are even smaller. This presented a real challenge serving only the Connecticut market. Plus, there were folks across the country that were asking us to come to their market. So what do? We offer a range of financing products that fund energy efficiency and renewable technologies. Our products and financing solutions include both debt and equity. We serve various sectors, including multifamily, nonprofits, municipal, commercial, and single family. We also have a services business where we run programs for others. So for example, we continue to run several of the Green Bank's multifamily programs serving low and moderate income communities, as well as other Green Banks. And we have a national single family loan product called the Smarty Loan. Now, just in terms of how we define harder to reach or underserved communities, we have a pretty broad definition that includes low and moderate income communities. It includes buildings that serve low and moderate income residents, as well as credit challenged borrowers. We also focus on sectors where capital isn't flowing. For example, smaller deal sizes, harder to underwrite borrowers, and newer business models where traditional lenders aren't necessarily comfortable providing capital. So a couple of words on challenges of serving harder to serve communities. Pretty obvious, pretty kind of straightforward list, but I'll just walk through it. In certain places, there's either no or inadequate capital or financing solutions. Other times, financing solutions exist, but they just don't work with the specific sectors that need it. And just seen numerous instances where folks are developing solutions they think the market needs, but they end up not working. So financing solutions can be too expensive for these markets, right? Folks can't take on a lot more debt, so it needs to be affordable. It needs to be a combination of grants and loans in order to be affordable. Another big one, products are too complex to use in these harder to serve markets. Folks running buildings, running nonprofit community development corporations are stretched so thin, they can't take on one more complex thing. So it has to be easy and straightforward. And then finally, projects are just too small. They're not financially viable. There's not adequate scale. So I'm going to just start by just kind of talking about some example challenges we've solved through our products in this sector through a case study example. So one of our first projects that we worked on was this East Meadow condominium in Manchester, New Hampshire. Manchester, Connecticut, I'm sorry. I'm thinking about different states. This was, first of all, a condominium complex, at least in Connecticut. It's much harder for condos and co-ops to get financing from traditional lending sources. This was a property, 88 units, housing mainly low and moderate income elderly residents that were on fixed incomes. The property was in physical and financial distress. It was mainly in physical distress because of a lot of energy related issues. The heating systems were like lemons at this point, constantly being repaired, band-aids put on them. Dollars weren't there to replace the systems. The roofs were leaking. Right, so all kinds of issues. They couldn't get a traditional lender to fund them. CPACE wouldn't work because they couldn't get, say for example, a approval for a mortgage that was secured by the property or a CPACE lien. However, if those energy improvements were made, it was going to really bring this property back into the green, both physically and financially. So the project that we ultimately ended up financing was boiler replacement, lighting upgrades, some building envelope improvements, and replaced the roofs. All of this we were actually able to finance by underwriting against the energy savings that resulted from these improvements. So the total project cost was $654,000. In this project, utility incentives were $34,000. In many projects, we see utility incentives are significantly higher. Those should always go in as like first money into these projects. So we financed $620,000. Estimated annual savings of $79,000. The debt service was $53,000, leaving an estimated free cash flow of $26,000. This was a 20-year loan at 6% with a payback of 7.8 years. This loan has been funded. It's been out there now for about 4 or 5 years. It turned out that it's actually performed much better than this. They've had significant maintenance cost savings because it's not like putting band-aids on the equipment all the time. The repairs also put them in a higher insurance category, which saved them $36,000 a year on insurance. And this project is one where they've actually been able to write checks of up to $500 a year back to the individual residents because of the savings here. Energy improvements unlocked significant cash flows. And so what was the financing solution here? The financing solution was a product designed for mid-cycle properties like this. So you're not creating a new capital stack, you're providing a loan on top of existing debt. And because this property wasn't able to take on additional mortgage secured debt, the solution that was developed is non-mortgage secured. It's alternatively secured. So there's a UCC1 lien on measures that you can put a UCC1 lien on. And then we took a guarantee against the HOA, the homeowner fees. So there was some form of security. And so in Connecticut, this is called the Lime Loan, Loans Improving Multifamily Energy. Inclusive Prosperity Capital offers this nationally as the Catalyst term loan. And just kind of in terms of overall results in Connecticut and impact, through our multifamily programs, combination of solar and energy efficiency improvements, we've touched just under 10%, or we've serviced just under 10% of the properties that serve low and moderate income residents. That's both subsidized and non-subsidized, naturally occurring affordable properties, catalyzing over $120 million of total financing, and really playing an important role in not only making energy improvements to these properties, but preserving these properties as affordable housing. So this is just my final slide here. This Catalyst product that I've just described, that's underwritten on energy savings and energy related savings like maintenance costs, insurance cost savings, is a core building block for IPC. This is an example of another company that came to us, Block Power. They came seeking for financing help. This is a group that's operating in challenging markets in the urban core, where borrowers often have no financing solution. So the alternative is to do nothing. Their customers include affordable multifamily, nonprofits, small and medium commercial buildings, including houses of worship. They offer an equipment lease for heat pumps and other efficiency improvements that's based on a technology-enabled process. So we, IPC, help Block Power structure a $5 million credit facility that they could draw on for these leases. And this work has also helped them get investment ready and to graduate to a larger capital facility. And now Goldman Sachs is in the mix, funding them at a much higher level. So I will end there. Those are just a couple of examples of how we are serving harder to serve communities.
Kim, thank you so very much. That was terrific, very really right on point to the questions that we had discussed and that people had put forward before the meeting. Jensen, you had a question, and you're in the queue.
Yep, Salvador reached out and had a question. He says, Kim, great financing terms. And then there's a few questions, so we can take them one at a time, or you can in your response. How did you manage to get those terms? What were the Connecticut Green Bank terms? And finally, what was the average monthly payment per household?
Okay, so in terms of the terms for the Catalyst loan term, these terms were, they were really, so we run this program with a local community development finance institution. They were the ones that established the terms. It was really a combination of, you know, the credit enhancements that were in place provided by the Connecticut Green Bank. The Green Bank provided capital along with other providers, you know, like what was going to work in the market, what was needed in the market. But the CDFI running this program also needed to be financially sustainable, you know, and make some profit in order to be able to continue operating the program. And these were the terms that really kind of hit that sweet spot. Okay, so second question, I think there was another question about what are the average monthly household payments? So good question. What's important to understand about these loans is that they are loans for multifamily properties. The loans are made to the property owners, and it's the property owners, not the households, not the residents, that are repaying these loans. And loan size ranged anywhere from around, I think our lowest was around $15,000. Our highest has been 3 million, and it's been like in that, we've really operated in that broad range. You know, and that lower end is really where there's big market need. I missed, what was the other question in there that I missed?
What were the Connecticut Green Bank terms?
These are the Connecticut Green Bank terms. What I'm showing on my screen right here, it's so 7 years, 5.79%, 10 to 20 years. It was about in this range, maybe just a little bit lower for the Green Bank terms. Sorry about that. Yeah.
Oh, no, that's great. And Kim, we have another question for you. Are you able to serve, are you IPC able to serve 2 to 4 unit naturally occurring affordable housing?
So that is just an absolutely great question. The answer is no, we don't have a solution for that. We're talking to some other partners about figuring that out. Nationally, I will say at least in New England, most of our low and moderate income residents live in smaller investor-owned properties that include the 2 to 4s. We don't have solutions out there for this segment. It's deeply needed, and hopefully with the new funding coming in from the new administration, we can put the resources into addressing that sector, which is challenging and costly.
Great.
Kim, thank you so very much for your presentation. It was really good. We are at the end of the 2-hour session, and I wanted to thank everybody for participating. I appreciate Kim, Peter, Mike, and Charlie for everything that they did in putting their presentation together and taking the time to do this.